Hello, ladies and gentlemen, and welcome back. In less than 24 hours, we should find out what's going on in the US economy. Will the Fed raise 75 basis points as expected, or even upwards of 100? This could make a big difference to markets, and at ahead of critical levels, this will be a big thing. Now, on top of this, we also have the other interesting information. What's going on under the hood? You'll notice I have the Dow here on the chart. Now, the Dow's been outperforming the NASDAQ and the SP500. This is not only unusual, but it doesn't bode well for the economy moving forward. So join us today as we go through the history of when the Dow outperforms the rest of the market. And let me just tell you, it's been a while since this has happened. Stay tuned. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We've got all of those coming up at the key levels we should be looking at, but let's start off with the macro data and then of course lead into the earnings season and everything else that's going on right now. So it may come as little surprise that industrial stocks have been one of the best performers over the last couple of weeks. In fact, they've surged relative to pretty much anything. If we look at the Dow Jones Industrials versus the S&P 500 ratio, you can see for the first time in quite some time, it's been outperformance. Now, when we have such a strong recovery, what does that mean for markets? Well, if we pull the stats, and you'll notice that it's been a little while since we've had outperformance here from this particular index, then it is very, very interesting indeed. And in fact, if you go down here, the 1 week, 2 week, and 1 month later results don't even show more than 50% positive after such a thing. The problem with the old economy, that is the industrials, is that they tend to be excitable for a little bit, but they're not sustained. So they're not like tech where you see ramp on ramp on ramp. And you can kind of tell that before. Look at these pickups followed by dumps, and we've got the pickup right now. So yeah, it's all good at the moment, but it may not hold, and it probably won't based on the statisticals. What about industrial stocks based against the tech sector? Well, they're beating the tech sector as well. Again, very unusual to see such things occur. When we've had the reads like this, it bodes even worse for the economy. When the industrial sector is beating the big tech sector by amount such as this rate change of over 10%, we tend to see incredibly weak numbers coming out of that sector and in fact the market afterwards. Yeah, it does bode again badly for the economy because it's defensive. People are going to the old economy and saying, oh, this is where we want to park our money. Well, that's an issue because, of course, what does that tell us about the new economy? Potentially, it has sickness in it. And another indicator that we'll show later on today's video will show you that again. This market is moving up with defensive-like properties. That is, it's going up with defense in mind. That's not what we want to see if we believe this is a robust recovery with the word pivot all over it. What about smart money versus dumb money? It's getting closer and closer and closer to what we usually have seen this year be a turning point. When dumb money has overtaken smart money, we've usually seen that be close to the peak, and we've had that a few times. So this is a chart that we'll be watching. Remember to subscribe if you're interested in seeing when that particular switch does occur. We also want to bring this chart back up again. Just remember, 2-year yields peak around 1 to 1.5 months before the end of the Fed hiking cycle on average. What a great statistic. We know that April and March of 2023 is basically where we have the hike increase max, the terminal rate. Now, if we do reach that, that would mean that we shouldn't see a 2-year spike until probably more like February of 2023. What would that potentially mean? Higher 2-year yields leading in. Something to keep in mind, and we'll continue to watch that. Remember, if we see a real topping here of yields, the market starts to recover, then we can start to say, well, maybe we do need to question whether this market has found a bottom. It doesn't look like it at this point. Some other stats that are wary, of course, we've talked always about conditional seasonality. We know in midterm election years, we tend to see bullish strength right now. We know that in normal years, we tend to see the center rally and bullish strength right now. But in bear years, when we pull them out over all of the history, we tend to see a turnaround here to the negative side. We're in November now. We've just started it. And that's where we start to see this shift towards the negative side. Will it happen again? Michael Burry thinks it will. He's cool. I think it's a pretty cool stat here with the VIX. Basically, he doesn't like the idea that the VIX hasn't found a really high fear period. Usually during any bear market, you get really high VIX. That is a 45 plus freakout zone. And once that happens, you tend to have potentially the capitulation low. Most bear markets end with fear. That is, extreme fear comes in and you cannot see, was it the forest from the trees or the trees from the forest, whichever the one is. Someone in the comments will fix that up for me. But yeah, basically we're around this area right now. Now, if we see a turn to the downside and the market starts to freak out, do we have this spike? This is where we are at the time of recording, effectively to the VIX. We're looking for that 45 plus. Let's refresh together the earnings beat data so far. Still 65% at the time of this recording. Beats 696, misses 379. It's a little bit under what you'd usually want in a healthy economy, good earnings period. And that, remember, is revised bad earnings. So it's not like the economy is doing that well. It's just beating mostly bad expectations. AMD did do okay, at least according to the post market. It was up about 4%. Maybe that will move towards a gap fill. And the rest of these stocks, of course, we are following. We've got Roku coming up. We've also got Etsy. That could be a nice double combo. We'll find out what happens there. Etsy in particular, I'm interested in. Remember, this earnings season, I really want to know what consumer discretionary stocks are saying about the economy moving forward. It can be a very good one because they're on the ground effectively seeing demand sometimes before even the official figures. The official figures sometimes lag this stuff, so it is important to look at. So just before we jump into the charts and we take a look at the key levels that we should be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, I've got Tesla up here, and you'll notice that, of course, it's been up, down, and all around. In fact, when we look at it later, it just filled a gap that was sitting over here. Now, why I want to bring it up is, again, just to really detail the fact that you should be setting alerts on your charts. Make sure you set alerts and make sure you have a platform that lets you do that, because then you know when something's hitting those levels or moving towards a key zone. There's so many stocks out there, so many stocks that, of course, Tiger Brokers offers, and we can't see them all. So alerts can be a very helpful tool to you. I also want to just quickly point out that now Tiger Brokers does offer some fractional shares. Now, I'll talk more about that in our next video, but that's something that is becoming a really needed thing with so many stocks that are so high in price. Being able to go to fractionals is super important. But I really wanted to focus on this one. It's been a little while since we brought it up. We're in earnings season, so it's good to be able to do this. We want to be able to see the filings, the summary, the shareholder percentages, dividend statements. What about the short interest? Some of you out there would be very interested in that. And of course, the valuations, fundamentals, financials, and everything else. Well, you know what? It's all here. There are not many platforms that offer something like this. To be able to go and have a look at the quarterlies, to be able to go and have a look at the valuations in terms of what people expect it to be worth and all these other things. It's great to be able to do that within the platform. Look how much information is here. So if you're interested in joining Tiger Brokers, you can do so by clicking the links in the description down below. Remember, to the Australian and New Zealand audience, there's also a special offer for the FX Evolution community, extra zip stocks for you. Fund with as little as 1 cent and you get those. And yeah, thanks so much, guys. Well, let's now get into the big stuff. Let's talk about the key levels we should be watching. Well, first up, VIX is down. Is that in line with our theory? Yeah, it totally is. So VIX is down, potentially the calm before the storm. I'm not sure we're going towards 20. So usually we've gone kind of 20 up to 35, 20 up to 35, 20 up to 35. This has been fairly easy for us to figure out this year. I have a feeling we would go around here to maybe 22, and that's where we'll bounce. It just doesn't seem likely that I believe everyone will now see this. And when everyone knows something, it doesn't tend to work. Let's talk about US 2-year. What happened in the last 24 hours? Well, we continue to rise. We're not on all-time highs yet, but we're getting damn close. And remember, the stock market has held pretty well. Now, that's unusual. If the yields have been going up, the stock market has been turning over. And if we do get a new high on these yields, I would expect the stock market to really have a bad time of it. So that's something that we need to keep in mind. If they remain disconnected for too long, that's been unusual in this year. If we move over to the US 10-year, you can see it is dropping. This is starting to tell me that people are smelling a weakness in the economy. Remember, we are inverted at the moment. That means that the US 2-year is higher than the 10-year. 2-year inverted, we've got 5-year inverted, we've got 3-month inverted, everything's inverted. So what that's showing is that maybe now people are feeling a little bit I guess, sick on the US economy moving forward. If we start to see the 10-year invert even heavier against the 2-year, it really shows there will be rate cuts on the horizon, but there's also a sickness somewhere, according to the market, for the US economy. What about high yield corporate bonds? Well, they had another poor session. Not incredibly poor, but definitely a poor session. If this continues to decline and the stock market continues to go up, remember we've seen lower highs show us that the market was about to turn. High yield bonds, worthwhile watching. Don't ever discount the bond market, guys. It's well worth it. You just need to know how to read it. But high yields have been pretty good. If we continue to see these drop, the stock market stays sideways, that could be an early warning sign that you may want to consider the short zones. So what happened on the dollar? Well, the dollar fell back to this level, this previous level of demand, and it found demand again and rallied heavily. It's now made a higher high. Now, has it hit our level of turnaround yet? Not really. It didn't quite hit the 112. You'll notice I have a little alert sitting there. And that's interesting. But we need to add a new alert now because we've seen that it's bounced off this zone. So I think if we end up getting a low taking out these kind of areas here, that the dollar is going to start to weaken pretty heavily. For now, though, it's made a higher high and it kind of looks like it wants to continue up now to go and hit these previous supplies. What happens there? Well, we'll find out. It's not really the type of way I'd like it to go in. If I was feeling short dollar, I'd like it to go straight into there to allow the turn. When something stops about 80% of the way you expect and does what it's doing right now, can be looking for hard breaks. So make sure if you are looking in here, you wait for some form of confirmation, whatever your systems may be. Of course, you need to practice your own risk management, but that's just something that I've observed over the years. What about the euro? Well, the euro is back in the demand zone. It bounced early, it then came back down, and now we're kind of moving on up. And we do have a bunch of supply and a bit of issues over here, but we've made a new low. So I've got a little alert sitting up here, price-wise, for anyone that's not able to see it, about 99.70. I'd like to see it take those highs out, and then potentially we'll be seeing pickups of buy demand. But it's synergized with that DXY. At the moment, these are the two demand zones. I don't think we have a strong enough reason to say this is buying just yet. We just know that it's in a level that was previously respected. Let's move over to gold. Now, gold actually looks a lot better on the table compared to the others. We broke through all of these supplies, all these resistances. We made a lower low. We've breached both of those and we've pulled back. Now, I have an alert just underneath where price hit, and it didn't quite hit my zone. I liked it to go into here. So I'm still looking at this. I'm open to something like that occurring and potentially then moving on the way up. But I'll be very focused on the DXY. Whatever the US dollar does, I think will affect gold heavily. And remember, if yields continue to go up, that is the 2-year makes a new high, I don't like gold in that situation. Gold and yields are not friends. That's the way it usually has been. Oil, congrats if you're in the long. This was a really nice kind of previous resistance or supply. We saw all those wicks, and then it came down, it hit that zone, and it found initial strength. Look, we thought it would in the last video. Yeah, I felt pretty good about that one. Now it's coming back up to previous supply. So it's basically at the target zone. If you did it, well done. To break this may be pretty difficult. You might be looking for a closure above that zone with no wick. You've noticed before, wick, 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 and currently a wick. We need it to probably do a close, and go and focus on this area here and have a look at how it broke. That type of thing can synergize many, many, many times when you're looking at these charts. So oil looks okay for now. I still maintain the exact same thought process on it over the medium to long term, but we'll find out. I want to just add copper into the fray as well. I've got it trapped at the moment between two different points, and copper can tell us some things about the health of the economy. Basically, it's one of the most used metals. It's used a lot in the current economy, of course, to grow and expand all of the infrastructure. If copper falls through this kind of pennant style triangle, then we could be looking at further weakness for the US economy and further weakness for markets around the world. Demand destruction, effectively. So I've got a little alert here at 330 just in case. And of course, you may want to set an alert at 360 if you're looking for the bull squeeze side recovery of the markets. We're open to both, but at the moment, we're stuck in the middle of the range ahead of the big news coming out. Tesla traders, oh, look at this. There's the gap fill that we had from the other day. And it just went a little early. And I think what that is it just proves that you should be always considering your zone and taking slightly earlier than the obvious choice. And that's with everything. But if you did get that out, well done. I think that was a very good little target profit. It was not a bad trade, I guess you would say. If we have a look at the 5-minute, you can see that the market opened pretty aggressively. You would have had to be pre-market here. But even trying to sell off this level, you could see it hit that gap for the first time. Tesla's not giving us too much. Like if we look at the 2 hour, we would say, okay, this looks like it's in recovery mode, accumulation. We've got that kind of low, the max pain. We found those wicks that showed us that there might be some aggressive buying. There was, but I would follow the stock market more than Tesla at the moment, because Tesla's still reeling after that earnings result. Not quite hitting the expectations. It's holding now, but who's buying? Most likely retail traders in droves. Volume's not down heavily. I've still got 180 sitting there, but I think following the S&P 500, and then if you wish to get into Tesla, that would be the way I'd play it. Apple had a pretty poor session, down 1.75%. That's kind of what you want to see if you're a bear in this market. You want to see the biggest stock starting to flail. And we had some other ones that I just want to mention here. Look at these fall-offs. Amazon, new low. Wow. Google, look at this new low coming down to some of our alert levels that we've set before. You know, this was not a good day for many of these stocks. I mean, these are new lows. I mean, who would think that we're making new lows, losing 4.39% on Google, and the market's like, oh yeah, it's all good. We're in a pivot. We're all recovering. Everything's all great. I don't think it looks great. You know, consumer discretionary and tech usually lead recoveries. I could be completely wrong, but it's through history. That's the way that you usually do see it. This is very bizarre, and we saw those stats before. It doesn't bode well, so I'm using the stats to help us here. We'll come back to that chart. Let's look over XLY, XLP. Again, this shows us consumer discretionary versus staples. What the hell's going on here? XLY getting smoked, going down against the staples. People don't like the consumer discretionary side in comparison. It's not good. Previous recoveries, we've seen them both come. This time around, we're recovering on the stock market, yet this is not happening. That's not what I want to see under the hood. The Dow is just so much stronger than the others. I mean, we're on the trend line now towards potential sell-off, but yeah, I mean, again, the Dow, look at those strong candles here. Let's have a look at how much it is. So from the bottom to the top, we've had a 15.6% recovery. That's a pretty decent squeeze. And while it's not unheard of this year, it's actually one of the fastest ones. In fact, for the Dow, you can tell it's the fastest one. This puts us as only down, even at the time of this recording, about 11.43%. That's actually not very bad at all. I mean, that's easy to deal with in most of the world, only losing about 11%. So yeah, it's not really having any problems. Let's have a look at the UK 100. Again, another market that's doing really well, mostly because of financials, energy, and materials. And that's a huge part of the FTSE. We still have an alert down here just in case we close below this level, because this could still be part of a massive distribution. And that's where I believe we would be seeing the capitulation, the fear coming into the market. Should this make a new low, expect fireworks on the rest of the market. The DAX is something similar here. The DAX hitting that trend line, slowly grinding higher thanks to the old economy. But this has been a move into the old economy. Everyone's jumping into that thinking it's more defensive, or there's recovery, or maybe it's just government spend. I don't know why they like it so much, but they do. And then we move over to the NASDAQ. I mean, it looks pretty bad. Another little double top. Probably see a recovery into the news event, and then potentially further selling off back into this 11,000. There's not much to like about this market as of the time of recording going into it. We've got the breakout levels. We've got some key supply zones in the future, but there's not much to like. Let's move over now to the S&P 500. We'll actually use the real market just so we can demonstrate the three levels we've always spoken about now for a long time. The first supply, this level here, we're in it. The second supply, this little backed up zone. Well, we didn't quite reach that yet, but that's certainly there. And then the third one, the most obvious one to all, is that 4,100. And the reason I say it's the most obvious to all is when we zoom it out, you can see, look at this. I mean, this is the trend line. I mean, we use this super effectively over here as a community. Well done, guys. Yeah, I mean, that's where we're at. So we expected the recovery after we saw that ridiculous candle that came out here. So far, we've expected the squeeze to this zone. This has been relatively tough, and I'll explain why in a second. And I don't blame, I think probably the currencies have been easier than the stock market from around here. If you're trading options, then you wouldn't care. You'd just be like, yeah, it's easy. But if you're trading CFDs or futures, it could be a little bit harder. Let's have a look. So we've got this rejection candle after making a new high. Okay, that's very interesting. I mean, we all know that as a shooting star. Some of you will know it as a pin bar. Yeah, it's a rejection style candle. It doesn't bode well for what's coming in the news. Now, the news will do whatever it feels like, but if we're looking at pure technical signals, we'll talk about that in a second. We've got this trend line. Now, I haven't played it out. Let's see if it... Okay, so it kind of... I mean, I'd have to curve fit it, which I'm not going to do, but you can see that it kind of sits there between the last lows. So we've got the low here, bounce, low here, bounce, and each time it's been making a series of higher highs and higher lows and higher peaks. And then all of a sudden, we've found this period here. Now, we had this the other day over here. We had a high, a higher high, and then we had a lower low. And we thought, okay, well, that probably means there should be shorters in here. And there were on the smaller time frame for like 5, 10 minutes, 15 minutes. And they tried, they failed. Then the market made a new high. Okay, then it made a new low. Okay, then it made a higher high. And then it sold off pretty aggressively with some big sell-offs in Amazon, Google, and some others. Now we find ourselves on the trend line. So what may happen is we may recover. I've just got this 38.87 just to show kind of the type of recovery you might see. And then potentially we see that drop off. And if we get underneath this trend line, especially if we get underneath 37.60 in the future, you've got to think that's a rollover of this market. That will actually take out one of the last big swings, which trapped a lot of people, no doubt, into shorts that were getting squeezed initially. Maybe they had their stop losses taken in the last 24 hours. It all seems like a lot of manipulation. This is the head of news. If we're looking at it on the surface, short time frames are now starting to say sell. Long time frames are still on the buy side. And what I mean by long time frames is like probably more a 2 hour, 4 hour daily time frame. But this anything under 2 hours is kind of saying, you know what, this is moving into the sell side. So as we find out more, we'll definitely update you guys. I'm going to put an alert under here because I think it's important to know if that does get taken. And the next 24 hours, I would expect fights between the bulls and the bears pretty heavily around here, with a new low being formed, kind of snapping that trend line with a series of higher troughs. And then if we get underneath 37.45, watch out down below. And we'll explain that in the next couple of videos. What about options? Do they help us here? Well, coming into the Friday non-farms options, all we know is 360 should be mostly defended. That's where most of the puts sit. Everything else is pretty useless. And the open interest amount is a quarter to a fifth of what we usually see during a big monthly event. It's why we don't bring up this too much. Now, in our next video, I will have a little bit of information coming out about whether we've seen leveraged money reducing their positions or not. I know a few people asked me about that to bring it back. I'll do that in our next video, and we'll cover it in some detail. So definitely watch that one. Bitcoin is doing its best to hold up. Still holding above here. We've got our potential turnaround short zone, and we've also got, at the moment, technically still a bullish market moving towards 22. If we look under the hood, I'm probably sure I could find some bearishness, but I think Bitcoin's holding okay here. Remember, if this fails, what does this look like? This was a Wyckoff gone wrong. All of a sudden, this becomes like a UTAD, and then we move down, series of lower highs, lower peaks, and then if you're a Bitcoin bear, or more importantly, looking for cheaper price, we get underneath here again, I think it's going to be bedlam. I'm going to set an alert there, and I'm interested to see what happens. I am interested to see what happens. Let's move over to the calendar. FOMC press conference coming out. Of course, this is a big event. The statement, the funds rate, 75 basis points expected. The press conference, how annoying. The worst bits of news we could have, yeah? Creates a lot of instability, a lot of big moves potentially around the markets. Then we've got the ISM Services PMI on the Thursday at 10 a.m. New York time. And then we scroll down to the other big bit of news. Has the US economy started to slow? We actually need jobs to be lost to really beat inflation. I know that sounds mad, but it's what we want. We want a cooling economy. Otherwise, we're just going to sit here and potentially enter into a horror show of stagflation, and it's not what we want. I mean, some of you might think that's good, but I would rather that we just reset here, get it all over and done with, smash it out, and then over the next year, hopefully start to find some form of recovery. But yeah, we do want to see what happens with these jobs numbers. And once we do know, I can bring some stats together so we can find that when we see weakening jobs, that is higher unemployment, we have some timelines to do with the recession, wording, and everything else. Thanks so much for watching. If you enjoyed today's video, remember to subscribe, smash that like button. And of course, if you're from Australia or New Zealand, check out Tiger Broker's special offers with the zip stocks. And if you're around the world and you're interested in getting a platform such as that offers all the cool tools, check the description as well. And there's a bunch of special offers for different people around the world. Thanks so much to the community. We'll see you in the next one. Bye for now.